friends, this is Martin from Edge, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show where we try to understand how the market performed during the previous week and then plan for a better trade during the next upcoming week that's beginning from tomorrow, February 5th, Monday 2024. So if you are not subscribed, please subscribe and share to friends and colleagues and so that it reaches out to max. Thank you. Here is the summary of where I will come back here after having a look at the charts. This is a weekly view. You see that there's a cup and handle. There are multiple flag patterns and breakouts, and eventually there is some consolidation at the very top, which again could be the fourth flag potentially. On the right side, the Banknifty charts are also showing a similar pattern of cup and handles and multiple flag breakouts. But during the last move, we could see that the consolidation is broken down, and that's quite different from how the Nifty had been doing on the weekly charts. This is one view. Another view is price moving within a parallel channel. Nifty at the very top and Nifty somewhere in the mid, trying not to fall at the bottom of the channel. This is a daily view. We could see that there is a range bound consolidation that's happening primarily on the Nifty, while there is a breakdown of that consolidation that has happened and a recovery back to that you can see. Look at this candlestick pattern on the weekly on Nifty and Banknifty. You can see that there is a very good bounce that has happened after the 2 weeks of fall that led to 4.5% of correction. But the candle is absolutely bullish with a lower high low, open high open low pattern, right? So, and Banknifty, you can see that it also did a bounce. That's after 4 weeks of red candles. As it is Nifty, a deeper correction but a good bounce. But the thing is, it is the body of that is completely inside the previous white range candle, right? And the wick size little more as compared to Nifty. So that indicates some small consolidation and selling pressure from the wick size, but good bounce after weeks of correction that had been happening. Bullish candle on both weekly. On the daily, you could see that the last candle that is formed is an inverted hammer. Inverted hammer on the top of a rally could indicate a reversal in case it's not confirmed. In case the price moves below the candle slope, it could potentially, that's all. But the wick size regardless indicate the huge profit booking on the sell off that is there at this 22,000 and 20,125 nearby all-time high zones. In fact, Nifty did make a new all-time high as well after coming out of this consolidation zone. You could see for the last 5 days, if you see, it was very volatile. A 400 points up move, 200 points loss, another 200 points up move, and then a pause, and then the Friday have a breakout which didn't sustain. So it was very volatile. The volatility indicator moved as high as 19 somewhere in time, and then settled 16, 15, and finally closed at 14.5 something. So very volatile week because of the Fed and the budget. The Fed meeting outcome and the budget came on an expiry day this time, and the market was rising up the volatility, which cooled off after that. That's probably what happened last week. Banknifty also had a volatile week, but it was more or less trending up. It took the budget outcome positive way, considering the macroeconomic fundamentals indicated in debt reduction and all that in the budget outcome. But the Fed meeting outcome was not good. It was hawkish. Probably because of that, the banks could not sustain the move. They did try to move to the 47 and then could not sustain. but the candle that is formed last is almost like an engulfing pattern, although not the full body of the previous candle. So weak is not covered here, but it's a wide range bearish candle. Wide range bearish candle and a long wick inverted hammer at the top of a running Banknifty is not that great. The Friday's close is not that great, but it did break out on the Banknifty to make an all-time high. That's already make a note. Japan's indicates that it's a contraction confirmed, which gives more sideways moves with bullish bias because it's greater than the 20 median of that bullish band, 20 moving average. On the Banknifty also, you can see that the contraction is given. Is confirmed on the Banknifty, which was expanding on the downside earlier. Now it's contraction confirmed, so it's sideways movement confirmed more or less. But the fact is, it's closed below the median of the bands, Bollinger Bands, and that's the reason why Banknifty has got a bearish bias. But otherwise, sideways movement is what the Bollinger Bands are indicating. We'll come back to study the Nifty support and resistances here. Before that, just wrap up quickly. So it's a green close. A decent bounce. In fact, New York time high also came. 500 points plus is what Nifty gained last week. Bullish candle, positive close. Banknifty 1100 points. It's 2.47. Good bounce, but it's an inside bar on the weekly as well. The bullish bar. Right now, on the daily charts, Nifty closed 156 points positive. On the contrary, Banknifty closed bearish, 280, nearly 0.5% down. Another important thing to note that it could not sustain the move above the 20, 50 and 100, but Banknifty closed much above the 20 exponential moving average. Alright, so there is some divergence in the way the market closed on the daily, on Nifty and the Banknifty, or as well as on the weekly also. It's well closed positive. Decent bounce, Nifty and Banknifty. In fact, both of them close above the 20 weekly exponential moving average. Right? But dailies were the major differences there. Right? So basically, it survived the even volatility and it managed to close green. And in fact, Nifty wanted to move further out after completing the correction and the move breakout. But that breakout went into huge sell-off from the top. That's what happened on Friday. But Banknifty has taken the budget possibly, but the hawkish Fed probably the reason why it found resistance and is continuing with the correction. The correction is not complete there. Right? It's an 8.5%, a deeper correction that has happened there. So Bollinger has not got back from the bullish short-term momentum. We have to make a note of that. Both of them. Momentum is still not above RSI 60, although it is recovered some of the momentum of the trend that had lost during the correction. Right, so all the bands we've already spoken about. Let's just see the support resistance levels on the top. So the first resistance above would be 22,000, rounding number. This we have taken out on Friday, but still that would be a resistance. And after that, 22,127, which is a new all-time high resistance. And after that, it's an unknown territory, but given the flag size, it could go as high as 22,500. So rounding numbers would have resistances. Downside, the first support would come in at 21,800 surrounding number, and then it could find support at 21,600, which is 20 exponential moving average, and then 20 and 50 exponential moving average would come in as 21,200. Now, before that, you could find supports and the exponential moving averages of 23.6 as well. Right? That's coming somewhere at 21,400. 21,500 also is the rounding numbers and major supports. So that's how. Downside, it's upside we've already seen 22, 22,125, and then anywhere as high as 21,500. Downside 21,800 first, 21,600, 21,500, 21,400, 21,200, then 21,000. There is a gap also there, very close to that, 29.50. And Nifty, the upside resistance will be to close above the 20 exponential moving average. That's coming at 46 to 43. That's the thing. So 46 to 50, there has to be a close above that. That is first hurdle. So 46,000 250 and then 46,500, and then the major hurdle would be 47,000, which is 47,000, which is a big rounding number, and then 47,500, which would be a breakout of this consolidations on the box that you see. And after that, 48,000 is a big rounding number, as well as there is a gap there, the all-time high at 48,636. That's resistance on the upside. Downside, the first support would be 100 exponential moving average, that is coming near the 46,000 nearby zones, and then if that is breached, it goes to 200 exponential moving average, which is 44,650 now, right? Now 45k in between could be good support, right? And 46k in between also, so big rounding numbers will be good supports, right? So basically, price had breached this blue color channel, fallen down, took support near the 200 exponential moving average, bounced up and got back into that blue, and then trying to move towards the top of that. That's what's happened. That's where it met the resistance. Here, price had retraced 4.5% nearby towards the bottom of the channel, entered somewhere near the 50 exponential moving average, and started move up, and then almost completely recovered, and there is space left towards 22,500, 400, which is the top of the channel. That's what it is. We look at momentum and the trend indicators. We use the RSI for momentum. Anything above 60 would be bullish, anything above below the 40 RSI would be bearish. We also use ADX indicator to understand the trend, so momentum and the trend, and we analyze it on multiple time frames, the weekly charts as well as daily charts. Left side the weekly for Nifty and the Banknifty, right side the daily on Nifty and the Banknifty. So what do they indicate? It's absolute bullish momentum on the medium term on Nifty, but Nifty has some trouble with respect to momentum because it's still sideways, but it's rising up. Right side, the momentum has climbed in the bull zones, is yet to climb into the bull zones, the case of Nifty. Banknifty momentum is not even attempting that. It's falling momentum in the sideways, but it managed to climb back from the bear zones to the bullish zones. So overall, if you see, short-term momentum is sideways, not bearish in the long run, the Banknifty. But medium term, Banknifty sees trouble and remains on the side, not in the bear anywhere, but Nifty is strong in the short. So clearly there is a weak momentum and the trend that can be visible in the Banknifty for sure on medium term, but in both medium term and short term, it's sideways, not bearish any longer. That's what you're understanding. So it has recovered to sideways. Banknifty has recovered, but lags behind with respect to momentum and the trend when you compare this entire system. This is a summary of that. Take a look at that. We move ahead and try to understand the volatility. We had understood that earlier with the help of Bollinger Bands. That's one way of studying the volatility. Now we have the India WEEKs. That provides an indication of that as well. So it's 14.69. It had a spike of nearly 6% last week. Obviously the market had event days, but it shot up drastically up, but cooled off later after the event, and still it's not that low, right? But it just managed to remain the 50 line. So anything below above the 50 to the, and if it hits goes towards 18, 19, then it's outside of the low volatility. So it managed to close below the 15, so we could still say that it's low volatility. It had huge volatility last week because of various reasons that I've been saying, but finally it's managed to cool off some of it, but still it is there. It's reasonably at the edge of breaking outside of the low volatility. If you combine the volatility spread difference between the implied volatility and the realized volatility, actually it's still a 10%, so not that much favor for the option sellers that way. The open interest is next study that we do. We could see there is a divergence that's seen here as well, because Banknifty is long and winding and it is bearish in nature. That's for the futures open interest letter. Nifty, it is long build up, and so there is divergence in the way. Open interest for the February 8th in Banknifty and February 7th in Banknifty and February 8th Nifty. So this weekly options open interest net if you analyze, we can see that the put call ratios are bearish. Not much bearish, but 86 on the Nifty, but more towards the bearishness than the Banknifty with a 0.71 put call ratio. So here also it's slightly weak in the Banknifty. So Banknifty is bearish, more bearish as compared to the Nifty with respect to option data. Something to make a note of. So it's not only in the price, not only in the momentum, not only in the trend, not only the momentum, not only the price, but also the open interest for the futures as well as the option. We see that the Nifty is much stronger as compared to Banknifty. Banknifty lags behind. This is evident from the same charts of the options. You can see that all these green resistances or the call options that is written, huge resistances out there. And the difference between the highest strikes where the highest put writing is seen and highest call writing is seen is 2,000 points just for the weekly expiry. That's hardly 4-5 days ahead. 21,000 and 23,000 is where the highest put and call writing is seen. The second highest is at 21,600 and 22,200. That's also wide. Second highest. So this wider range where the option writers are better at the highest put and call is because there is a market, this expected market will go volatile. Or they have no close. That's what it is. Banknifty also, look at the highest put writing at 44,000 and the highest call writing at 47,000. So the market participants, especially the option writers, big players, are thinking that it can be too volatile. Market is somewhere at 46,200 something, and it can, people are expecting that it can spike up 1,000 points plus, and it can go 1,500 points down. So that's too wide a range for betting in the Banknifty as well. The second highest is seen at 45,000 and 49,000, 4,000 points fight. Second highest put and call writing is planned there. So that's very volatile week is expected by the option writers, at least as of the Friday. On Monday things will change, those option data will change, but this as of now, this is what is indicative. Now we analyze the different sectoral indices, the IT sector. So overall, just to brief, we had a fabulous recovery across the sectoral indices. Across the sector, there is a recovery that has happened, except for the FMCG, which is slightly flattish and remains to be in the sideways momentum on the short term. But otherwise, medium term, if you look, all the major sectoral indices are in the bull zones now with respect to the momentum on the medium term. So it's 2.4% up on the IT, 2.4% again up on the metal, 4.1% auto sector, huge moves, pharma nearly 1%, less than that, 0.77%. Reality is 4% up. So we have the movement that's happening across multiple sectors that indicates the big buying and the big price up move of the index that can be expected. So you could take long positions in all of those except for the FMCG. You'll have to wait for some time. These are the sector indices charts on the Nifty. You can see that it's blocked out from the consolidation zone and surrounding pattern or a cup pattern zone. The market is having bullish momentum in the trend. The breakout from here could be huge. There could be a reversals that could come in as a cup and handle. All this possibility there. Keep a watch of that, but absolute bullish as well. The IT sector. Metal is within inverter head and shoulder breakout. Long way to go. It's within a channel as well. So absolute bullish momentum. There's every chance that as per the price action momentum and the trend that it can move further up towards the channel top, several thousand points up. Auto sector is at the all-time high and broken out of that parallel channel. All-time highs and absolute bullish momentum are rocking. Pharma, all-time highs, breaking out, momentum, all-time highs and absolute bullish momentum and trend. FMCG facing some resistance after hitting the top of the channel and then kind of consolidating, but absolute bullish momentum and trend on the weekly charts. Reality, all-time highs, breaking out, some small retracement happened, but it is having a divergence and then absolute bullish momentum. But remember, it's in the top of the channel. So who's on the top of the channel? We'll be slightly careful. Auto Reality, right? Auto Reality is at the top of the trend line channel. Probably there may be some consolidation that could be expected. Otherwise, but across the sector, bullish momentum is what you see there. Now we try to understand the industry heavyweight stocks, the 5 heavyweight stocks that contribute maximum to the index. To begin with, the largest contributor, HDFC Bank. A rough time, bearish momentum, big sell-off had happened following the results for the last several weeks, and it continues. Just holding on that trend line in the edge of that wedge, just holding on. Any breach from here could take it to 1300. That would still be only the bottom of the consolidation, so from where it can take support and bounce up. But if this trend line is long going as the COVID times, if that is sustained, then it could mean that the sell-off is ending here. It has found a bottom here and then it could be flying up from here. But bearish momentum is what HDFC, in spite of all, this is the only thing that's stopping the index from shooting up to 22,500, 23,000. HDFC Bank, it's only culprit and the largest contributor. So this is the concern of the market, for the bulls primarily. Lens did a beautiful job during the last several weeks. It has been breaking outside of that consolidation zone and then a solid wide range bullish candle with rising momentum, rising trend. Absolute bullish. ICICI Bank climbed back to the bull zones once again, but it's heading towards the top of the trend line channel. That's very close by. All are very close to the all-time high levels. But momentum retained on ICICI Bank also. IT sector was doing good, and it's bullish momentum, and it is just begun the breakout from the flag patterns on both Infosys and TCS, and that's very interesting, and it's a long way to go. Absolute bullish momentum and the trend. Kotak Bank still sideways as it has always been, zigzagging in the range, the contrast stock. ITC is retracing, FMCG signs in trouble, sector worries itself. Momentum has slipped in the sideways and falling. So we have a mixed bag here. The IT and Lens and is upholding the market. IT and Lens, the Infosys, TCS and Lens is holding the market. When we are having deep trouble with HDFC Bank, some bit of trouble with ITC. But ITC is in a cup and handle pattern. Probably it may retrace till the 425, 400 zones and then start to breakout moves from there on. But it has slipped to sideways nonetheless, whatever. So HDFC Bank, ITC having trouble. Lens bullish breakout, holding the markets. Breaking the markets, HDFC Bank, Lens, IT stocks absolutely doing good. So it's a mixed picture that we are getting with respect to the selling and the buying from the industry heavyweights that contribute maximum to the index. Moving ahead, we're trying to understand how the foreign institutional participation is happening. Look at this. Last week we had Fyers continued to sell. They had been selling since many weeks now, and they sold as much as high as around 40,000 crores just in the last couple of weeks, and it's another 2,000 crores of selling that we had seen last week, but that's very less compared to what they had done earlier in the January month. So it's a relief, but it is the mutual funds and it's domestic institution money that's flowing. It's very evident by the 10,100 crores of buying that has happened in the cash market last week. Now if you look at the F&O, the foreign institutions are bullish, while the pro traders are the kind of property desk people are contrary to what the Fyers are, but the client or the retails or brokers are similar in favor of the bulls, similar to how they find. So although it may be, market may move further up is what is possible, but this is as of later Friday. This is what their view is as of Friday. So bullishness expected from the Fyers side. So we're going to follow with sharks. So Fyers has been sellers the entire January month, big seller selling, and we see some green in February. Well, at least they've stopped the selling intensity while the domestic institutions are catching up and have been buying big time in the January month and now extending that to the February as well. So institutional support is there, but the hawkish Fed outcome, we don't know whether FI would continue to do the selling or not. That would make the market very volatile. Now our study moves on to the global markets, the currency markets, and the global commodities. Begin with the currency market. The dollar index is spiking up. It's 0.5% up. What happened last week? It had moved up to 3.2% from the bottom, from single low if you see, and it's at 104 nearby levels. In the momentum is sideways, not hitting the bull zone, but sideways and rising up. Lower is slightly moving up. But the USDNR or the currency, the rupee has gained a little bit by closing below the 83, but it remains to be at the weak point and completely managed by the RBI not to shoot above that and remain there, neither to fall down. So rupee is at the 83 levels for quite long time, probably a year or so, within that ascending wedge. Right, you know what could when it could break out from this towards the top of that 84-85 range. But as of now, rupee remains weak, but some small gains last week just before used on our currency pair trading. Moving on, crude oil is showing a big fall after trying to consolidate some period and then move up towards the top of the trend line channel, which didn't work out. Momentum is sideways and dropping. It's a relief to an oil importing company like ours, but oil marketing companies not sure how they may take it. Gold has been on the top, not ready to fall down after having hit the all-time highs several weeks before. And showing green candle, but momentum is slightly slipping sideways and it's trying to get back there. So consolidating at the top, you can say. Oil is consolidating at the bottom. Now we study the three major US market indices to understand how the global cues are. Dow Jones is breaking out all-time high, green solid bullish candle that you can see on Dow Jones. Same with Nasdaq, bullish breakout all-time high, wide range bullish candles with the rising momentum and the trend. Same with S&P 500 also. So absolute green bullish momentum is seen in US market is very positive because it's a mother market and it has been rallying similar to how we had been rallying 1,000 points in January, 2,000 points in January. So it's 1.42%, the Dow Jones 1.4% up on the S&P 500 and then 1.3% up on Nasdaq. So bullish and it's rising bullish momentum above RSI 60. So that's a good cue. So the major concerns as of now seen on the global markets, good cues. Two actionables for the next week's one is Tata Consultancy. It's an IT stock, IT is rocking, momentum is good, volumes are good, it's a flank pattern, it's just started the breakdown, it's a swing, push, and both weight can work out, it could go as high as 4750 probably. Risk is this, let's give this over 1.5, and if it falls below back into the channel, which is also the flag, that means it's over. Otherwise, there is a potential that it can break out as much as the height of this flag. Reliance Industries absolute consolidation breakout is seen. It did break out. It already started, probably a little late, but still some more space is left. Considering the height of that, it can move as high as 3,300. So traded from there. Good volumes, good momentum, good trend. Good in the sense bullish, absolute bullish. Mans Industries and TCS, Tata Consultancy Services, weekly charts are what you're seeing there. Absolute bullish momentum and trend is seen. That's why with volumes, and there are long calls for the next week for the swing trading opportunities, swing as well as positional, but have tight stop losses. Actionable for the next week, weekly option strategies on the Nifty would be bear call spread. So if market falls by any reason, you will not lose much, and risk reward would be favorable, but get out one day before, and very low risk and very low margin requirements. Manage your portion risk. If the wick spikes up, come out of it and have tight stops and get out early before the last day. And wick spikes, get out immediate, and portion size as per your risk appetite and the capital size. Basically, you are selling a call and buying a much higher call by creating a spread, and so which makes sure that if market falls by any chance, you stand again, and market if rising, the strategist would hope that the market would rise beyond 22,320. As long as it's rise in that range, it should be fine. But if it's unable to rise and it's falling, it should be fine. It's completely risk defined. A simple bear call spread is what you see here. Now that we've seen a lot of analysis, we have come to some stock picks and then some strategy and options and all that. Let's just wrap it up. So market survived an eventful week with heavy volatility. Finally bounced up as well to make the all-time high by Friday and managed to close green, although it lost some of the gains earlier. So in fact, the thing is, it recovered fully the correction of 4.5% on the Nifty, but the thing is, the banks are lagging behind. It had trapped the bulls. It is indicating more of consolidation. It is facing resistance at the confluence of the 22 DMA, and the correction is deeper, and recovery is also getting tougher in the case of the banks. And remember, we have the mid of 26 to 30% plus of rally. In the mid of that, mid of a correction, the mid of that, where there's all breakouts to the all-time highs that is happening in December, January. So what's in favor of the bulls? A full recovery of the correction on the Nifty, a new all-time high on the Nifty. FI is not selling much in beginning last several days. Big buying by the domestic institution mutual fund money that's flying in. FNO data is showing bullishness, medium bullishness, and the weeks still remain below 15 low volatility regime. The Nifty remaining medium-term bullish on momentum as well as the trend. The green US market rising up to all-time highs. We have sectoral indices showing across all the sectors bullish momentum and the trend in the medium term. These are all in favor of the bulls. But what's in favor of bears? So the inward candlestick pattern at the very top after hitting all-time high on the Nifty is kind of dangerous. Banknifty is resistance at the 20-50 exponential moving average, as I said, is trouble. And an inside bar close indicates not an up move but a consolidation at least. Lagging behind Banknifty overall the trend and the momentum. The hawkish Fed outcome and the minutes of that and all that could trigger more of high selling is something that can be anticipated by the players. Bollinger Bands are showing downside expansion on Banknifty. That has stopped actually. It's last week's thing. Please ignore that. But it has put a bearish bias. It has stopped the downward expansion, but it's still the distance from the median to the price is huge, so it can be heavily volatile and it has got bearish bias. So that means expansion may restart, could restart potentially as per what we can see from Bollinger Bands and daily charts. So, and the put call ratio on the futures is having some trouble on the Banknifty. Put call overall PCR is not that great. It's bearish in fact. indicates that and a very wide range indicates that it can be very volatile next week. Several factors in favor of the bears and the bulls. What has happened last week is a recovery of the correction and a survival of a eventful volatile week. In between making a new all-time high and losing some of it because of the banks, which is lacking behind and performing bad. All eyes obviously would be on the bank and see if the recovery is happening. So it all depends on if the Banknifty is able to close above and come out of that bottom yellow channel that we have seen earlier about the 47,500 zones. If that happens, things are good. So technically, I am having a neutral view with a mild bearishness, even when the market is at a very reasonably high level, because I suspect the Banknifty could cause trouble. If the Banknifty performs, then my view goes wrong. But as of I feel that Banknifty is facing serious trouble and something has to come up really to lift it up. So global cues, Russian fears, interest rate fears, war, COVID, and all these uncertainties could come in any time and then screw up all the analysis and then cause black swings. So all we have to do is protect our capital by having positions taken in derivatives and options only with hedging strategies, and have tight stop loss in the cash. So every time there is a dip that happens, a crash happens, or not a crash, a correction happens, it's an opportunity for you to invest in SIP for quality stocks. There are options. Regular income strategy is also there, which can be used when the market is falling. Check out the playlist to have a look at that. So protect your capital, have hedge positions, have spreads, and decide on direction or wrong direction depending on how the momentum is moving. Play it accordingly. Right now, we are absolutely in a sideways zone. It's a little bearish bias on Banknifty. So devise strategies and non-directional action accordingly. Now for the next week, 21,000 and 22,000 is a wide range that we can look forward to. 44,500 and 48,000 is another wide range on the Banknifty that we can look forward. But as long as this 21,000 and 47,000 somehow is consolidating above the zones, then we can look forward to a variety going ahead. Otherwise, we may fall back to more corrections. Right? So play it safe and have happy trading and happy learning ahead. Subscribe if you're not subscribed. Put in your feedback, comments, and share to us that reaches out to Max. Also check out the Twitter channels where we have regular technical charts posted. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.